Good afternoon, everybody. Welcome to the show. Welcome to Newview. My name is Ran Gimeno, and I couldn't be more excited this afternoon to welcome my friend and industry colleague, Joe Hart from RealSource Properties. Joe and I have been working together for some time, and Joe has a lot of experience in industry, over 35 years of experience, and is going to be talking to us this afternoon about something that I think most of us wondered but never knew what it was, and that's the topic of behavioral finance. Joe has been a thought leader in the behavioral finance space, does a lot of discussions and conversations regarding behavioral finance and asset allocation. And something that folks don't know about Joe that we'll cover later in the show is that Joe is a survivor of the Miracle on the Hudson. So we'll be covering that and a lot more about behavioral finance. And with that, Joe, I'd like to kick it off to you.
Thanks, Ran. Thank you very much for having me here. When you start to think about this behavioral finance topic, which we're going to go into today, it is a passion of mine. I stumbled upon it truthfully about 22, 23 years ago. And as far as I'm concerned, it helps me understand the fundamentals of our industry, our business of investing and helping clients attain goals. So I'm open to any and all questions, conversations that you want to have. I brought a slideshow with me that might be entertaining, but why don't we just kick it off and take it for where you want it to go?
The floor is yours, my friend.
All right. So as I said, behavioral finance is an interesting topic. We use it in our industry because we're in the finance or investing business. So we like to put the behavioral finance part on it. But irrespective of that, what we're really talking about is behavior. And when we start talking about behavior, what you really boil it down to is decision making. And in order to fully understand decision making, hence behavioral finance and why we make the decisions we make, you need to understand how the human brain processes information. Yes, we're all different, but at the end of the day, our brains all function relatively similar. And so I have up here a slide for you just to help you understand. When we're taught to read every letter and then combine those letters into words and those words into sentences into paragraphs, and paragraphs become thoughts, if you will. So many of us are looking at this slide, and in first blush, you kind of look at it and say, I don't understand what's going on here. So the human brain is a very powerful muscle, as we've learned. And although we think it may read every letter, it actually looks at the groupings of letters. And so long as the first and the last letter in the appropriate order, the brain can interpret it. And I just use this graphic to set the tone. What we're really going to talk about is decision making and ultimately how the brain processes information. And we all kind of do it the same way. So we're going to see things pop up on a regular basis. So Amy, if you would, take us to the next one. So today's conversation or topic or presentation is going to be around behavior finance. I like to call it decision making and money, or more importantly, bring it home and put it in our laps. Why smart people do dumb things with their money. And I say that a little bit tongue in cheek because this is not a program or an explanation or a discussion to make anybody feel less intelligent or even dumb. What I really want to do is enlighten us and make sure that we understand we're all humans. And as humans, we do things a certain way. And that way is the way the brain processes information. So let's go on, Amy. My intent today is to talk a little bit about our business, the business of investment advice and investing over time. I'd like to talk a little bit about thinking in the brain, and I've alluded to that already, how it works and why it functions the way it functions. And I'm going to tie it back to some real world examples, both my personal example that Ron alluded to at the opening, as well as some other exercises, if you will, that will drive the point home. I was taught a long time ago when I first entered this business in 1988 that I can talk all I want, but at the end of the day, as much as you want to be educated, at the end of the day, if I don't keep you entertained, you're going to tune me out. So today's session is really about educomedy. And I say that so that you can laugh with me. There will be certain areas in here where you might feel bad to laugh at me, but you can. I've been laughed at many times. I've got 4 children. I'm laughed at a lot. So enjoy the presentation, and hopefully you can walk away with a little better insights as to how we go about making decisions. Amy? Disclosures. Next one is a disclosure. Go ahead, Amy. And the next one is a disclosure. What these all basically tell you is the small print says that in the event you disagree with anything I say today, have ever said in my life, or may possibly say in the future, my attorney is going to tell your attorney I was never on this program. So that's what the small print basically says. Go ahead, Aim. So at the end of the day, we're all doing the same things. We're all looking for information. We're all interpreting data. We're all trying to get to the same end result. And that is, at least from an investment perspective, to accrete wealth. The point is, it's not really what we're watching. It's what we're seeing while we watch it. So I think, go ahead, Amy, click through a couple. This is what we see on TV. And funny thing is, I can go from channel to channel and get talking heads that are diametrically opposed with their opinions. So then I'm forced to figure out what I want to figure out on my own. But unfortunately, the brain is lazy. So sometimes we just take all this for granted. And what we see is a bunch of talking heads. But what we want to see is the underpinning or the underlying opportunities that are presenting themselves as we watch all of this data pass by. Go ahead, Amy. So let's start in the beginning. I went back and really started to try to understand and become an academic in the investment business. And what I learned was prior to 1932, almost all of the recommendations we as financial professionals made to our clients, investors, were based on speculations. That basically is why we had so many bubbles and bursts back in the day. And the realities of the world were we just heard a conversation and we liked it. So we ran back and we talked to everybody we could talk to and either say buy or sell, whatever our viewpoint was at that point. Now, there was an inflection point. It happened in 1932, as I said. It changed from speculation to mathematics. 1932 marked the first publication of a book written by Graham and Dodd called Security Analysis. I'm not sure what edition it's on right now, but it is essentially the investing Bible, especially if you want to be a CFA. Now, what it did was simply say this: you don't have to speculate anymore. We've created mathematical formulas by which you can apply any security and then determine whether it's overvalued or undervalued, whether you should sell it or buy it. Life goes on with some modest changes. A few years later, we introduced the capital asset pricing model, which is an addition to the math structure, which simply said, okay, if we're going to take on certain risks, we should be able to try to quantify those risks. And if we can quantify those risks, we should get a premium for those risks. And that's what the capital asset pricing model says. If I'm going to take more risk, I should get greater returns. That led to a couple more changes. The most notable of was the efficient markets theorem, which basically assumes all information is disseminated simultaneously. It's come under the gun a lot over the years, but basically that was the creation, if you will, of modern portfolio theory, or what we like to refer to as asset allocation today. Harry Markowitz and his team got the Nobel Prize for that. In the late 80s, there was a study that came out that went relatively unnoticed to the general public. It's called the Brinson-Hood-Biebauer study. The title of it was Determinants of Portfolio Performance. A lot of misunderstanding came out of that study. And the misunderstanding is basically that most people, if they've heard of this study, will credit 90+% of their portfolio's performance to the asset allocation decisions, not the security selection decisions within the portfolio. I'm here to tell you, I've read both studies intently. Doesn't mean I understand them fully. But what I will tell you is that is not a true statement. What the studies ultimately said is 90+% of a variance in performance can be traced back to the asset allocation decisions, not the security selection decision. Or put a simpler way, oversimplified. It says if you have two portfolios over 10 years, one does 10%, the other does 12%, 90% of the 2% variance can be traced back to the asset allocation decision, not the securities owned within the portfolio. This is really the core of a fundamental belief in our business. Go ahead, Amy. We refer to as the 60-40 portfolio. 60% allocation to equities, 40% allocation to traditional income-producing products. And we've lived by this model portfolio, if you will, with minor adjustments based on age and risk tolerance. But we've lived by this model for the better part of 80 years, and it has worked fairly well. But since the Brinson-Hood and Biebauer study, there have been a couple other additions to the process of mathematics, if you will, Amy. The first of which started to occur, go ahead, which is the policy portfolio and the endowment model. This was introduced by the former chief investment officer of the Yale Endowment Fund, which is the second largest endowment fund in the country and the top performing endowment fund in the country. And what this policy portfolio paper did was it basically came out and said, in order to be a successful long-term investor, you need to have as many low or uncorrelated assets in your portfolio as possible, which led itself to the next advent, if you will, Amy, which is referred to as the human decision-making and how it affects market pricing. Now, the fascinating thing about this paper, which was written by Daniel Kahneman, is that Daniel Kahneman is not in our business of finance. Daniel Kahneman is a professor of psychology at Princeton University, and he was awarded the most coveted prize in the financial services industry for his paper entitled How Human Decision-Making Affects Market Pricing. Think about that for a minute. Somebody from outside the industry was awarded the most coveted prize. What this basically says is, irrespective of all the mathematics that we can apply to investing, one of the most critical factors is the human behavior of decision-making. So go ahead, Amy.
So
this
really,
now lends itself.
For a second. So what we're really talking about here is really psychology. That's really what we're getting at. This is really more of a psychological component than anything else. And
yes, I'll go a step further with you, Ron. And not only is it psychology, it's really the foundation of emotional. And we're going to talk a little bit more about that, but that is the psychological makeup of the human mind. And ultimately, we render an emotional overlay to a lot of our decision making. And so, interestingly enough, about 10 years after the modern portfolio theory and such, there was a publication put out by Harry Markowitz himself entitled Market Efficiency, a Theoretical Distinction, and So What? Where he actually stepped back and said, you're right, the math works so long as you focus only on the math. But once you introduce human psychology and emotion to the decision-making process, you usurp a lot of the mathematics, and that changes outcomes. So if you will, Amy, that leads itself to a new revised thinking that maybe 60-40 isn't the most practical of portfolio constructions, but maybe we should look for something different. There's a lot of variations on this. I've kind of settled on a personal note on the 40-30-30. The first 40 and 30 is traditional stocks and fixed income. The balance of 30 being non or lowly correlated assets to traditional stocks and bonds. And that's really just a way to think about this as we go forward. So Amy, if we can, what I've looked at, no matter how many papers I've read or studies I've looked at and reviewed and tried to educate myself, what's fascinating is there are three fundamental columns that support successful investing over the long term. And only three key determinants. Amy, the first one is essentially the security selection process. So what you decide to own inside of your portfolio has a material impact over time on the performance of that portfolio. The second pillar, Amy, is that of the portfolio construction. Now, this is a very big conversation that we don't have time to go into today. So I'm going to kind of just put a blanket over it and say this is essentially the asset allocation process. So not only what we decide to own in our portfolio, but how we choose to mix and match those securities within our portfolio and balance the risk will have a material impact on long-term performance. And then lastly, Amy, the last determinant in successful investing is the behavior patterns of investors, how we go about thinking of our portfolio. So what's fascinating is Vanguard in the late 2010, 2011 timeframe, in their effort to try to support do-it-yourself investing, if you will, that's what they're known for, low-cost do-it-yourself. You don't need investment help. They did a study. They commissioned a study. The fascinating thing about the study was it came out and said, you do need help. It's wise to have professional help when you're making investment decisions because it helps you get out of your own way. Hence, if you noticed in the last 15 or 20 years, Vanguard has been making a move towards investment advice. They actually have a division within their organization that is dedicated to providing advice. Now, what's fascinating in their study, if you will, Amy, security selection, if you do a good job in that category, it can add between 0 and a full 1% in performance to the portfolio over time. Versus portfolio construction, that can also be additive to upwards of 120 basis points or 1.2% of performance addition. The most fascinating component, if you will, and notice those first two are ranges from 0 to 1 or more. Behavior pattern, Amy, isn't a range. It can add up to 1.5% per year in returns to your portfolio. And if you compound that over a 20 or 30 or 40 year investment lifetime, that is material increased value. So if we'll go to the next slide. So the key here is looking at portfolio. As I said, math is one piece. Now we got to talk about the mind. There was another book written not long ago called Fast Thinking, Slow Thinking. And this really breaks the mind into two basic components. One is the quick responsive part of the brain. And then the second is the contemplative second part of the brain, where we think about it before we render decisions. So going to the next slide, I don't think anybody has trouble figuring out what this slide is trying to say to you. As soon as you saw this, your brain immediately interpreted it. This person is upset and they're making sure I know it. Versus the next slide, that's fast thinking. What is 19 times 24? Well, if you're like everybody else, you have to stop for a minute and start thinking. By the way, you don't have to do the math. Go ahead, Amy. I'll make it easy. The answer is 456. I just use those two slides to help you understand how quick your brain is to pick up on social cues. That's the fast thinking part of the brain versus the slow thinking part of the brain where it's deliberate and mathematic. Here's another one. The human brain does not like ambiguity. So as you look at these three boxes on your screen, you may see on the left-hand side the letters A, B, C. And on the right-hand side, you may see the numerical order 12, 13, and 14. In the middle, you will see a box that says, and approach the bank. Stop for a minute. What does that conjure up in your forethoughts? My guess is you probably see a young lady who has paddled her boat to the shore of a river or a lake, has jumped out of that boat, and is walking up the embankment of that lake or river. But what's fascinating is, why couldn't that be a young lady walking into a branch of a bank to make a financial transaction? That plays on recency bias, but we'll come to that later. The other part about ambiguity is you saw A, B, C, and 12, 13, and 14. But Amy, if you hit the slide, why couldn't it be A, 13C, or 12, hit the slide again, B, 14? The brain will decipher what it wants to decipher when given the opportunity or lack of context to frame things properly. Next slide, Amy. Let's skip through this. It's a fun exercise. Well, let's stay with it. Stop for a second, Amy. You will get the answer to this question. Be honest with yourself. What you want to do is try to time how quickly you can get to this answer. It's a simple math. It's a Jethro Bodine, if you will, goes into math. 2 goes into 4 2 times, right? It's that kind of math. Simple addition and subtraction. The key is try to figure out how fast you can do it. If we were together, I would have a stopwatch and I would try to time you. So here we go. Answer the following questions. I have a piece of candy and a piece of gum that together cost $1.10. Amy, the candy costs $1 more than the gum. Amy, how much does the gum cost? Quick. Be honest with yourself. What was your answer? Ron, did you have an answer?
Goodness, I will refer to you.
You chicken. Most people, believe it or not, answer the question quickly in a blink of an eye at 10 cents, which is very fascinating.
Right.
The interesting thing is the actual correct answer to the equation is, Amy, 5 cents. Now, what happened in your brain was you took the path of least resistance. You heard plus, minus, $1.10, dollar. You did the quick math. You took the quick answer, which was 10 cents. It's understandable. That's the way the human brain works. That's another example of how the human brain tries not to work harder than it has to. By the way, Amy, hit the next two slides. If you want the mathematical formulas, here they are. I like the Bodine math, which is the next slide. Dollar more was the thing, the spread to focus on. The only way it could be that is if one's $1.05, one's 5. The purpose of this is to show you that we have an inappropriate level of confidence sometimes when we render a quick decision. Amy, if you will, we're going to get out of some of these exercises. So let's go back, as Ron said, 15 years ago, 15 and a half, a little over 15 and a half years ago, to January 15, 2009, 3:31 p.m. in the afternoon. It was a Thursday. 150 passengers were boarding a U.S. Airways flight number 1549 at LaGuardia Airport, destined for Charlotte, North Carolina. Take a moment, if you will, and think. What were those passengers thinking about or expecting from that flight as they boarded at 3:30 that afternoon? Probably something along the lines is, I want to get on this plane, I want to get off the ground, and I want to land at my destination somewhere near Charlotte, North Carolina. That was probably the going thought through most of the passengers, if not all of them. Now, let's fast forward just under 5 minutes. The plane lands on the Hudson River. Go ahead, Amy, do the slide. Do you believe today that based on that experience, assuming those 150 passengers still fly, that they have that same thought process as they board a plane today? My guess is not. Go ahead, Amy. Because as Ron told you, I was on that plane. Go ahead, Amy. And I had an experience that has forever altered my view when I board a plane. So as I did earlier this week, fly home from a meeting, as I boarded the flight, my palms sweat, my heart races just a little bit, my mouth gets dry, and I'm uncomfortable. Now I ask you a question. Is that rational thought on my part? The answer is no, it's not. It may be logical because of my experience, but it is not rational. Why? Because even in spite of that experience, air transportation is still the single safest mode of transportation on the planet. And I get nervous on a plane. There's a greater likelihood that I will die in a fiery car crash pulling into the airport than I will die from a plane crash. And yet, I'll get in a cab with just about anybody, but I get nervous getting on an airplane. And that's how experiences alter our decision-making process, which ultimately varies our expected outcomes or our expectations of results. So, Amy, if you would. Expectations versus experience is a very natural thing. Go ahead, Amy. It's how we were designed. Without that process, we wouldn't have survived as a species. What you really want to take away is, Amy, that unexpected gains and losses are very, very intense to the human psyche. Hence, that's why I could tell you today, 15 years after the fact, what was going on during that 3-minute ordeal as if it happened yesterday. Because in my mind, it just happened yesterday. Next bullet point. Expected gains give us far less pleasure when we experience them when we're imagining them. Think about how many times, I'm a dessert guy. So I don't know, because I travel in my business, I get to go out to some pretty nice restaurants, and the highlight for me is always the dessert menu. So when the server comes to the table and asks, I say, describe it. And by the way, if you've ever done that, they do a fantastic job of making your mouth water. We've got this delicious cake baked in chocolate that has this oozing molten, and they go through this description. By the time they're done, I have drool running out of my mouth. I'll take that. They bring it to the table. I'll scarf it down. I'll probably bite your fingers if you tried to touch it. I eat it that fast. And when I'm done, somebody says, how was that? It was okay. It was never as good as I thought it was going to be. And conversely, the next bullet point, expected losses give us far less pain when we suffer them than when we're expecting to experience them. I equate this one to anybody who's ever had to fire somebody. You're calling somebody into your office and you have to let them go. As you're preparing for that, it's the worst experience. You're preparing for the worst. Oh, I don't want to do this. It's going to be terrible. I'm altering this person's life forever. And yet you go through the process. Afterwards, somebody comes in and says, how did it go? Most of the time, the response is not as bad as I thought it would be. Or take public speaking. Do you know that the most feared thing by human beings around the world is public speaking? When asked, most people would tell you they would rather die than get up in public and speak to an audience.
So, Joe,
I'm one of those. Yes, Ron.
So I'd like to make a comment. So essentially what you're saying is effectively the pain of a loss is essentially twice as great as the pleasure of a gain. Is that right?
Correct. Yes, sir. Yes, sir. So the point being is if it's a bad experience, like a plane crash, or maybe something like a portfolio value decline because of a market correction, that stays with us twice as long as a market gain of equal or greater proportion. And what we want to understand, go ahead, Amy, is your clients suffer through this. So do you. You may not realize it, but we need to make sure we understand our clients go through this, because that will help them make better decisions. Go ahead, Amy. So just to make this point salient and stick with you, they've done a lot of imaging of the brain, expecting dough versus expecting drugs. So anytime you do a study, you need a baseline. So the first graph you're going to see up here is the baseline. Go ahead, Amy. And this is the human brain at rest under a functional MRI. So again, there's nothing to note here other than the lighting up of certain aspects of the brain while it's at rest. On the bottom right, we have now brought in a drug addict, and we're doing the same functional MRI. But as we're preparing for it, we're telling the drug addict that they will be given a hit of cocaine at the completion of the MRI. And you can see that dark area of the brain where it lights up and it activates. And the brain is saying, oh, gimme, gimme, gimme. I love that. Give it, give it, give it. I love this stuff. I love it. Come on, I got to have it. That's what a drug addict's brain looks like when promised. They never gave them the hit of cocaine. They simply indicated they would get one. Versus the left side of the screen now, we're going to show you one of your clients or a typical investor. Instead of being told they're going to get a hit of cocaine, they're going to have successful performance in their portfolio. They're going to have a 10% gain. You know what's scary about those two pictures? They're almost identical.
Yeah.
So what's interesting here is our clients or investors are addicted to the expectation of performance, not performance itself. So when we frame things for investors about investing, we want to make sure that we manage their expectations so that it doesn't activate the addict parts of the brain to give unrealistic expectations. Go ahead, Amy. And this is all because of a couple of different things that go on inside the human brain. They're called biases or rules of thumb, if you will. There are cognitive biases and there are emotional biases. Cognitive biases are actually pretty easy to deal with because those are just simply mistakes that the brain makes through processing. Take that candy and gum example earlier, right? That's a cognitive mistake. Now that we've shown you how to get to the correct answer, you'll never make that mistake again, so we can correct it. Emotional biases are a little more difficult. Emotional biases are what I harbor towards airline travel. Right? And experience has forever altered that decision-making process, and it's a little harder to overcome than just educating me on how I did the math wrong. So the next slide lists a handful of some of the more commonly observed biases. This is in no way, shape, or form all-inclusive. As a matter of fact, I tried to do it one time. It was 7 slides, and I just ran out of patience. Yeah. But these are some of the more readily identified. And you'll notice I put a C or an E next to them. So that you could identify it was an emotional or cognitive bias. Go ahead, Amy, please. One of them that I like to talk about is availability bias. Go ahead, Amy. Availability bias, by definition, is the process by which we render a decision based on how readily available information is to my recollection. So here's an example. Which is more likely to cause death in the United States? United States, by the way. being killed by falling airplane parts or being killed by a shark. What's interesting is, especially after August Shark Week, which I'm a huge advocate of, I love watching Shark Week. Don't know if anybody loves that with me. But here's what's fascinating. Most people would answer this question, shark attack. When in fact, go ahead, Amy, you are 30 times, nope, next way. You are 30 times more likely to be killed by falling airplane parts than you are by a shark. Very quickly, the next question, similar of its nature. Do more Americans die from homicide or car accidents or diabetes and stomach cancer? Again, the fascinating thing, most people would say homicide and car accidents, when in fact, more Americans die from diabetes and stomach cancer than homicide and car accidents by a ratio of nearly 2 to 1. And then the last one, just to drive this home, which claims more lives in the United States, lightning or tornadoes? Well, believe it or not, lightning kills more people in the United States than tornadoes. Now, the reason I use this is it's an availability bias. Why is it an availability bias? Because things like plane crashes, shark attacks, homicide and car accidents, tornadoes, they make the front page of the news. Falling airplane parts, they don't make the front page. They don't make national news. Diabetes and stomach cancer, yeah, that's a big problem, but it's not on the front page of the paper every day. And yeah, lightning is a big thing, but it happens so frequently, it doesn't show you the same aftermath devastation of a tornado going through the Midwest. These things are readily available to our psyche, so when asked the question, it's easy to understand why we take the short, easy answer and make our decisions. Go ahead, Amy. Recency bias, another one. Availability and recency bias. How recently did something occur? So here's an interesting, it's a little dated in the presentation, but I still love it because I was giving advice at this time. What this chart shows you right now in the bar is the index of the technology sector during the 80s and 90s. What's fascinating is money or inflows or investor money going into this sector was very, very slow, but it was on fire for a long time. Yeah. Finally, we stopped resisting and said, you know what? This .com thing is for real. We should invest in it. So we flocked our money, chased the returns, and went into technology. As a matter of fact, in 1999, the average American individual investor had more than 78% of their portfolio either directly or indirectly invested in technology stocks. Here's what's fascinating. Once we started going into it, go ahead, Amy. All we did was experience the downdraft. Right. And as a result, it took many investors a decade or longer to go back into technology. They still gun shy of it.
And this is something that .com bust.
.com bust, absolutely. And there's some funny stuff you could talk about there in terms of stock performance and just changing your name from whatever it was and adding a .com
right
to the company name, even if you weren't in technology. That averaged a 43% increase in the stock price if you just put .com on your name. Go ahead, Amy. We'll go to the next one. Familiarity bias, another one. So we've got availability. How quickly can I make information available to my psyche? How recently have I heard about that information? Familiarity bias plays into that one as well. Typically, when given choices, we'll select the option that we are more familiar with, sometimes whether it's legit or not. It just seems familiar. So I'll use this as an example. I go to my family practitioner who is also a very dear friend of mine. He's been a friend of mine for over 35 years. We've played basketball together. We work out in the neighborhood. We do things, a lot of stuff, go out to dinner. So David's a good friend of mine. I was recently with him for one of my normal checkups. And at the end of the checkup, I was complaining about something. He said, Joe, let me write your prescription. So I said, okay, give it to me. And he knows my business. He knows my thoughts on behavioral finance. So he said, let's play. So he wrote me out my first prescription, which is, Amy, which one would I take? Go ahead. I looked at Dave. I said, Dave, I know you're messing with me, man. I have no idea what that is, so I'm not likely to take it. Can you help me out? He said, yeah, I'll make it simpler for you. Go ahead, Amy. So he puts up the next one. I said, Dave, stop teasing me. What are you prescribing for me to use? I said, geez, Joe, you're such a pain. Gave me my third prescription. That looked familiar to me. I said, still not sure what that is. Can you just give me, what is it? What is it you're telling me I need to take? He gave me the fourth prescription. Oh, all right. Let me go back for a minute. I didn't say I needed it. I'm not saying I didn't use it. I'm just saying I don't need it. Okay. But Eddie just led with, hey, Joe, here's Viagra. I wouldn't have questioned him at all. I said, shit, yeah, heck yes. Give me that stuff. I love that stuff. Give it to me. So familiarity makes a big difference. Make things as simple for your clients or investors to understand. They feel familiar with it. They're more likely to make the right decision. Go ahead, Amy. Familiar bias. Does this play out in portfolio structures? You betcha. This is the market capitalization of the world stock, some of the world stock markets, right? The United States makes up 50% of the world's market capitalization, which simply says 50% of the investment opportunities out there are beyond the borders of the United States. And yet, the average individual investor in America today has about an 85% allocation to U.S. companies. Is it unique to the United States? No. It's consistent in Japan, the United Kingdom, France, Germany, no matter where you go. Familiarity bias. That's my home country. I think I know more about the stocks or companies in my country. Therefore, I tend to overweight those. And that is not optimal portfolio allocations. Go ahead, Amy. The next one is sometimes we like to say, I need more choices. You're not giving me enough choices. Well, they did a study. I won't bore you with all of it. Go ahead, Amy. Choice is actually your enemy. The more choice you have, the less likely you are to make a decision, period, let alone the right decision. And if you go on, it's called the powers of three, rational choice theory. What's fascinating about the human brain is that it can only simultaneously evaluate three options. Literally, if you go four or more, the brain has to shut down and restart to effectively evaluate all the choices. That's why it's hard to make a decision. So I am, for lack of better terms, I'm recovering now, a Starbucks addict. So if I were to ask you, if you were a Starbucks drinker, you walked into a Starbucks coffee shop, how many sizes of Starbucks coffee would you see on the menu? Well, if you're a frequenter, what you would find is there are three. Go ahead, Amy. There's a tall, there is a grande, and there is a venti. By the way, venti is 20 in Italian. That's a 20-ounce coffee, in case you're wondering. Now, this is fascinating to me. I had to write a paper on this while I was going through some of my behavioral finance studies at Duke. And I was in Starbucks one afternoon trying to come up with an idea on what I could write my paper about. And I chose this choice paradox at Starbucks. So I sat there and I took notes, and then I talked to a bunch of people in the Starbucks organization. Tall, grande, and venti, as a financial decision, which would be the best size to purchase? Well, most people default to the venti. The reason being, it's only marginally more expensive than a grande, and I get substantially more coffee. The truth of the matter is, from a financial perspective, that's the worst decision you can make. It has the highest cost per unit, and if you observe, most people who order a venti coffee either skim off a half an ounce on the top to add their cream and sugar, or leave a half an ounce to an ounce in the bottom because it's gotten cold or bitter. So that might make you think tall is the best choice. It is. It has the lowest cost per unit, and most people don't know this, but if you drink it entirely on premise, they will refill it for free. It's a great program. Now that you know the best and the worst decision at purchasing a Starbucks coffee, what size would you guess outsells the other two combined by a factor of just under 3 times? You guessed it, the grande.
Oh, the
Why?
grande.
Why? Because it's the Goldilocks syndrome. Too small, too big, just right. Too cheap, too expensive, just right. To put it into investment parlance, too risky, not risky enough, just right. So what I can suggest to you is, when talking to or considering investments, if you have people who have difficulty making decisions, as I do, give them 3 choices and only 3 choices, and position the choice that you believe to be most suitable for their situation as the middle selection. The vast majority of the time, that is the choice they will select. And it's called choice paradox, or the power of 3s. Go ahead, Amy. We'll start to wrap up now. One last one is your attention bias. How frequently you see things will dramatically impact how you make decisions, especially in the world of investing. So when looked at it, if you looked at the frequency of negative reports, in other words, how many times the market reported negative returns, right? If you looked at a monthly, 39% of the time over history, you would see negative performance numbers. How many times do you think you would see annual returns of negative numbers? Go ahead, Amy. 14%. Now, everybody likes to look at their statements at least quarterly, if not more frequently. Do you think those two frequencies have an impact on how you allocate assets? Understanding that for the long term, equity is the overweight. You should have more in equities than anything else for the long term. The question is, monthly reports, if you looked at your reports monthly, it would reduce your equity exposure. Go ahead, Amy. To 41%, well under the recommended 60-40 beginning portfolio. Versus if you chose not to look at your returns, but on an annual basis, you would see something, go ahead, Amy, more appropriate to where you should be for a long-term investor. So we've talked about a lot of different things that influence decision-making, how the brain processes information, et cetera. Go ahead, Amy, let's go through the last couple slides. Herding and social conformity is one that I just love. As human beings, we like the power of numbers together, right? The thought process is if everybody's doing it, they can't be wrong. This is a Solomon Ox study that's been done since the 1950s. Every year, the results are substantially the same. You see a red line on the left hand of your slide. We bring 7 people into a room and we say, we're going to show you 3 additional lines. We want you to tell us which one of those lines, 1, 2, or 3, is closest in length to the subject line, that in red. So go ahead, Amy, hit them all. Keep going. Oh, they're in black. I'm sorry. So we'll go to the first person of study and say, which one would you say is closest in length? And that person would answer line number 1. Okay. Person number 2, your answer. I agree, line number 1. And we'd go right down the line and we'd get to the 5th person and say, what is your answer? And that person would stare at it for a minute and say, yeah, I guess it's number 1. We wouldn't have to ask anybody else because that's our subject. That's the person we're studying. What I didn't tell you is the other people in the room were instructed to answer the question wrong. And we wanted to see how often the subject being studied would side with those that led off, especially with numbers. By the way, the magic number is 3. So long as 3 people are in agreement before that person is tested, they'll agree with the curve. And we'd interview them afterwards and say, hey, how could you say line number 1 was closest to the subject line? It's line number 2. Everybody can see that. Their answer would be, well, to be honest with you, I thought that was the right answer, but I didn't want to make anybody upset. Or I thought maybe they could see something I couldn't see. Or I was sitting at the wrong angle. They had all the excuses in the world, but they conformed to the herd. Now,
that's the herd mentality that we talk about.
That's a herd mentality. That's why when the market is on a tear, everybody and their brother is running to the market to invest money.
You know, I'd like to pause there for a second. It's interesting you mentioned that. I don't know about you, but for me, I like buying things on sale, right? And so it's interesting when the market is down, everybody rushes to sell and they forget to think, gosh, maybe this is the time when I should be buying. And so to your point about herd mentality, we follow the herd and go against what we should, which is rational versus what's irrational.
Well, the old adage is successful investing, right? Buy low and sell high.
Right.
We do the opposite as human beings. Why? Because we have this thing called loss aversion. We're afraid of losing. As we learned earlier, right? It hurts twice as bad to lose money as it does to gain the same amount of money.
Yeah.
So we are very reticent to go into a market that's choppy or uncertain. We want to chase. By the way, I don't know if you go to shopping at all, but when your local department store has a sale, that's usually when I go shopping.
Right.
It's not when they say, hey, everything's full price, come on down and buy it. No. But for some reason, when it comes to
apply that same thinking when it comes to investing.
Yeah. So as an example, just to kind of tie this back to the work I do for a living, the last 2-3 years with COVID, real estate has been taking it on the chin. Lots of bad press, lots of bad headlines about real estate's not a place to be. As a result, people are shying away from it right now. And I am going to suggest to you that there are certain aspects of real estate that are poised to really take off in the next 3 to 5 years. And yet it's tough getting people to look at it. Not because it's not sound, not because 90% of the world's millionaires credit their millions with ownership of real estate. That's not why. It's because they've been reading headlines and they just don't want to go against the herd. So that's, I agree with you. It's when the market sells off, I'm usually reallocating to more aggressive classes of the securities.
Right.
Go ahead, Amy, unless Rand, you want to say something else. Oh, pause for a second. If we can, go back. Yeah. This is a fun one. I don't know if we have, nope, back. This is a video clip. I'll talk you through it because I don't think we have audio. I stole this off a TV show that I grew up watching called Candid Camera. It was one of my favorite childhood shows. It's a comedy. But this is an example of social conformity or herding mentality. And they go through a series of people on an elevator and try to get that person to adjust their body, if you will. So go ahead, Amy. I'm sorry to have jumped in. So here we are. The guy in the black coat is our subject. The guy getting on is a Candid Camera actor, as is this woman. And finally, the third person will get on. And you'll notice they're facing the back of the elevator. And our subject in the black coat, if you're like me, you can now feel his pain. You can feel his sensitivity that I'm bucking the trend. I'm doing something wrong here. Now, he knows the door is not behind him, but he will very slowly adjust to the herd's behavior. He'll even try to hide it by looking at his watch and ultimately turning around and facing the back of the elevator.
Isn't that something?
And it's not just this crazy guy. By the way, this is fun. I've done it. I do it to this day. I get a couple of comrades. You need at least 3 of you, and only one person on the elevator to do it. Here we are again. This fellow is not as discerning as the previous one, or it doesn't hide it as well. But again, our Candid Camera crew gets on the elevator with him. And boy, he just doesn't waste any time. I'm not fighting this. Nope, I'm turning around. And then we're going to see a third subject in the study here. Very similar, a younger man. Same basic thing. 3 Candid Camera. They've got him turning around, spinning in the elevator.
Gets up right away.
Right away, just goes with the herd. Close the doors. The doors reopen. They've changed positions. This poor guy, I laugh every time I see him. He's almost ahead of the herd now. He's turning before they are. Now, one last one. Do you think we could have a little more fun with this? One more time. Let's turn around. He's just attentive as can be. You see him looking. What are they going to do next? Here they go. Now, let's see. Can we get him to take his hat off? Oh, wait. Can we get him to put it back on? So we can't help it. It's part of our human nature.
It's how we're hardwired.
That's how we are raised, basically. That's our human nature. That's how the brain functions. One of my favorite quotes is this last one. Only 2 things are infinite, the universe and human stupidity. And I'm not sure about the former. And it's not that we're stupid, by the way. We are human beings. As human beings, we are emotional beings. Every piece of sensory data that your body takes in, be it touch, taste, sight, sound, smell, whatever, in 1/64th of a second, just to put that into perspective, that's faster than you can blink the human eye. In 1/64th of a second, all that sensory data is taken into your body. It passes through one center point of the brain called the amygdala. The amygdala are 2 little lima bean shaped parts of the brain that sit above the basal cortex. And it is what is referred to as flight or fight or emotional central. Within 1/64th of a second, every piece of sensory data passes through the amygdala to be evaluated. So one could argue that every decision we make as human beings is first based on an emotional interpretation of the data and then pushed into other parts of the brain, the slow thinking parts of the brain, to be rationalized or revised after the fact. And that's why it's important. We are human beings. We are emotional. We make emotional decisions. We don't do dumb things with our money. We let our brain react without questioning it. Slow down, think hard, Make sure you're doing the homework in making the best and most sound advice or decision that you can make as an investor or an investment advisor. With that being said, Amy, I think we're on our last one. Thank you very much, Rand, for having me. Amy, thank you for taking control of the slides. I hope you find this as value. We're available for questions or comments if you want. This is a passion of mine. Thank you all very much.
Joe, really appreciate your time and thoughts this afternoon. It's great to have someone like you on the show to help us better understand why we make the choices that we make. It's fascinating to take a lot of those case studies and those anecdotes and apply into our everyday life, not just investing, right? Like in terms of herd mentality. So the question is that you've given us a lot to chew on. Where do we go from here? How do we how do we try to not get ahead of ourselves so we can make thoughtful decisions that ultimately lead into positive outcomes over time? So if you had a recommendation for our account holders or investors, what should we do to try to take those, those thoughts that are irrational and not let them get ahead or take control of what we need to do to be successful investors?
Well, there's a lot of different ways to walk away from this, but in its shortest answer, I'm going to give you an example of how this manifests itself. But I'm not saying slow down in the decision-making process. I'm simply saying evaluate this decision-making process. Understand that your first response may not be the right response. So here's one to tie back to the plane event on the Hudson River. People make fun of me to this day for it. Plane crashes, I break my nose, I crawl out on the wing, I'm bleeding, I'm in 34-degree water up to my thighs, 27-degree air temperature. The second phone call I made while standing on the wing floating down the Hudson River was to U.S. Airways to book my flight home that night. Think about that.
Wow.
That is not rational thought. But in my brain, I was watching the plane and it dawned on me that all these other people were going to be trying to get home that night. And I didn't want to miss a flight and have to spend an extra day in New York City. So what happened after the fact, when I got to shore, I started to evaluate my decision-making process. Why did I do that? Why did I go out on the wing and not jump in the water? And I evaluated all my decisions and went through it. And that's when this behavioral finance stuff really took hold in my being. I practice it every day now because I evaluate all of my decisions and go, wow, did I really think that through? Did I consider all the options? Did I weight them properly? Or did I just make a really quick emotional decision and run with it? So I guess the answer to your question is go slow.
It's really important to take a pause, reassess, and not let emotion drive our decision making, right? Yep. And also, I think you mentioned this in earlier on the show, is that it's really we should really put a lot more stock into taking the advice of our investment professional advisors, to heart, and trying to get other folks to give us more information that helps us process whatever it is we're trying to decide on to make better decisions.
Well, yes, and I'd go back to the slide that had the 3 pillars in it. If you're dealing with an investment, or even if you're dealing with it on your own, no matter how good you are, the most valuable component to successful long-term investing is emotional coaching. Your financial professional is more of your financial coach than a stock picker or a portfolio builder, or those are all important components. Tax mitigation, all those things are very, very important pieces. But the primary reason you want them involved in your process is to help talk you off the ledge when you're on it and onto the ledge when you won't go near it. That's really what you want them for. So you want to hire somebody who has your same, if you will, tolerances and interests at the forefront to make sure that you're a long-term successful investor. And then just take their advice. Listen to them. You don't have to agree every time, but listen, evaluate, stick to the rule. Sorry, but
No,
that's it.
that's great information to take away with. I think hopefully our viewers will benefit from a lot of what we talked about, and have a better understanding again as to why we have made the choice we've made in the past and how we can do better going forward. And with that, again, we appreciate you having you on the show. We'd love to invite you back in the future. Always great to speak to someone like yourself, an industry veteran who's seen a lot of market cycles and has a lot of understanding of the capital markets and asset allocation, and again how we can hopefully overcome those outcomes going forward. So with that, thank you for being on the show.